Africa remains one of the world's fastest growing regions despite global instability. The continent entered 2026 with cautious optimism, with the International Monetary Fund and the African Development Bank projecting Africa's growth to 4.3%. While growth is expected to remain above the global average, instability in the Middle East has introduced new risks around oil prices, inflation, debt, and investor confidence. Africa's gains could now quickly come under pressure if energy disruptions continue. The African Development Bank has urged fiscal discipline and regional integration as buffers against external shocks. RMB's Isaah Mhlanga is here to help us unpack and make sense of this. We're in conversation with RMB's Isaah Mhlanga to help us unpack and make sense of what's happening in Africa. Isaah, let's start with the fact that in Africa we rely on imported fuel, and with so many African economies dependent on fertilizer and fuel from the Middle East, how exactly would you say, how vulnerable are we to this prolonged instability?
Thanks for having me for this discussion. I think if we just look in terms of the number of African countries that are oil importers or fuel importers, it's the majority of countries. Barring Nigeria that just built a refinery that is able now to export to other countries, you can think about Angola, Ghana to an extent. Most African countries, they import fuel, which means the continent as a whole is at risk from high fuel prices. That's one. But secondly, just the availability of oil, because we can forget sometimes that you can have the ability to buy, but if you can't access the oil, it's also a constraint. So most African countries are at risk. It manifests through various channels. One, there is the obvious transportation and logistical costs that propagates through the rest of the economy. And then secondly, there is the inflationary impact that impacts the whole economy, but it hits the poorest the most. African continent has the highest levels of poverty. So there's issues of food insecurity, which relates to the affordability of food, in addition to also not having access to readily produced food locally in the economies because of, it could be a lack of fertilizer. That also is a derivative of oil, by the way, which is also a big issue that we can talk about that we saw in the Russia-Ukraine conflict. And then there is the monetary policy response that we can also dig deep into that can exacerbate this impact of high oil prices.
So it's really going to impact on the continent, and it risks reversing our gains that we've been able to achieve through real policy shifts on the continent. And so do you think, having outlined what's happening, can this really derail our post-pandemic recovery?
It can derail the post-pandemic recovery, but if we look at economies now, they are a lot more resilient to external shocks than what we've seen before. If you just take the conflict in its totality, you have the fuel price impact and then you have the logistical impact. It takes longer to get inputs into countries. Most African countries are embarking on infrastructure investment, and typically they would import big capital goods, machinery into the country. But because the shipping routes have been disrupted, it now takes longer to actually reach the destinations, which means working capital for companies also increases. And that increases the cost of doing business in general that eventually land up at the consumer level. That's the other aspect that has to do with this conflict. Now, if you look at the expected economic growth rates at the beginning of the year, they're quite decent, just over 4%. The fastest growing region in the world, the IMF World Economic Outlook at the beginning of the year. Now you have slightly lower economic growth because of this conflict, which then means tax revenue collections for most of these governments is also going to be slightly lower. It's just a derivative of low growth, low tax revenue. And then you have the response to the fuel impact itself, where countries have to cushion consumers from significant increase in fuel by offering some fuel subsidies. We did that in a South African context. Many other African countries also gave subsidies to try and cushion consumers. But what is a subsidy really? It's simply income that has been shifted from government to the consumer. So instead of banking the tax revenues that you would have collected in the economy, you say you give that tax revenue back to the consumer so that the impact of fuel is less impactful on consumers. But that tax revenue was earmarked for something else, whether to spend on health or to spend on education or to spend on safety and security, which still has a need that needs to be filled. Then it means countries would have to go into the market and borrow in order to cover for that revenue that has been shifted to the consumer, which then increased debt levels. Post-COVID, most countries tried to consolidate. This shock then might reverse that consolidation by increasing debt levels again. And for most African countries, they finance themselves in hard currency, meaning in dollars, in euros, which comes with currency risk and the difficulty to actually repay when currencies depreciate, particularly in times of uncertainty. So you have this double whammy sort of environment. You are hit with an external shock, but also the macroeconomic environment turns negative at the time where you need financing that is much cheaper.
Isaah, so let's look at that as you just expanded, the high debt servicing cost. We know that limits the fiscal space for countries and it's going to impact them. What can they do?
Look, I think what we have seen since the pandemic is countries that have done economic reforms that increases the resilience of their economies to external shocks. I can take some examples. Nigeria, for instance, they removed fuel subsidies then. They also collapsed the parallel markets in currency markets so that we only have one exchange rate that is easy for investors to assess the valuations of assets inside the country, and therefore it makes it easier to invest in the economy. You can think about Ghana with debt restructuring, also Zambia with debt restructuring, which has actually helped to deal with some of the concerns that investors had. So most countries, they have done the reforms, which means this external shock comes at a time when countries can respond much more easier. But it doesn't take away the fact that with increased subsidies and increased debt servicing costs, it means it's going to be a burden for the fiscus. It's not just a domestic issue. When US interest rate increase, global interest rate increase, because that is the first risk-free rate that you start to look at when you try to price what is the cost of debt for any other country. It's a reserve currency, it's a safe haven currency, it always serves as a benchmark. Now, if you have US interest rate increasing because of inflationary impact that comes out of the Middle East conflict and increase in oil and fuel, it filters through into emerging markets, it filters through into African economies. But they have an added, negative characteristic, which is the fact that they mostly borrow in foreign currency. South Africa is slightly different, but for most other African countries, they borrow to a large extent in foreign currency. And when your currency depreciates, it means you're paying even more, not just the interest costs, but also the currency devaluations that comes with it. So it makes it a lot more expensive for these countries to borrow.
As I see, you've outlined this and talking about the resilience that economists have, but are we doing enough as a continent and African governments to diversify its own economies through imported energy and other infrastructure plans that the countries were planning to do?
There are policy decisions that are being made. Are they enough? Not nearly enough. Are they fast enough? Not nearly fast enough. But there are, policy decisions that are being made. I'll just mention a few. The first one is the Africa Free Continental Trade Agreement. It's a long-standing agreement that essentially seeks to increase intra-African trade, reduce the barriers to trade within the African continent, reduce the barriers to movement of people within the continent, to make, to make it easier for Africans to do business and invest in Africa. If you take Europe, they have a higher level of intra-European trade. They grow much faster. You take North America, they trade with each other a lot, which means they can actually invest and grow quicker. You take Asia, they also invest in each other's economies a lot. But Africa's intra-Africa trade is just 15%, much lower, which means there is something that needs to be done there. The policy decisions have been made. But until you have connectivity, it's not going to actually fly. It's much easier for me to fly out of the continent back into the continent than to fly directly. You can't find a direct flight from here to Morocco, for instance. You must fly out of the continent and back. That just increases the cost of transportation. And if I can't travel easily, it means I'm not also going to invest easily, because it's people that negotiate these trade and investment deals. And if it's difficult for them, it's going to be difficult to invest. I was watching one conversation with Aliko Dangote, alluding to this fact to say he needs 38 visas to travel within the continent where he makes investments. And when they issue a visa, you have to hand in your passport, they stamp in, then it comes back. It's such an inefficient system. So that's one aspect. Work through the ease of movement of people between the continent. And then secondly, the ease of movement of goods and services within the continent. And that is going to improve trade significantly so. And then the second one, just build infrastructure. Energy is one of those that is a must-have. With this new artificial intelligence wave that's coming, it requires a lot of energy. And for most African countries, we are still energy deficient, even before we add the need that comes from artificial intelligence. But what we also understood from different industrial progress historically, those countries that don't participate actually get left behind, which means Africa is at risk of being left behind from this wave of artificial intelligence if we don't invest in energy sufficiency to make sure that we can actually house the data centers, the basis of which is the data that is used in artificial intelligence. So we need to see African governments investing heavily in energy, but also making sure that we don't get left out of the AI revolution that's coming. We have talked about Cape to Cairo railway line for many years. It actually comes from Cecil John Rhodes back then. It's still relevant today. If we can't move the bulk goods by rail, it makes it a lot more expensive to move it by road. It costs insurance, delays at border posts because you still have to wait lines and lines, which means it's just too costly to do trade. And then it's safety and security. Tourism as a commodity that we can sell as Africa, it works well or it thrives when there is safety and security. So you need that. Investment also thrives where there is safety and security. And then just policy stability. When one government changed from a previous government, democratically of course, there is need for policy continuity, which then signals to an investor that when they make investments under a one government in the same country, when there is a new government after elections, those policies are not going to change in a way that disrupts the way that they will view the return on their investment. So that policy stability is very important. And that touches on the independence of central banks, where they are not going to be politically influenced in terms of how they manage inflation and monetary policy. It's also the ability of law enforcement authorities to actually hold people that are found wanting in doing things that are not supposed to be done accountable. All of those things, they contribute into creating an investable environment, which then can attract fixed investment, both from local investors and from offshore investors. And then the last one is, which is I think is quite important, until us as Africans invest in the continent, we must never expect external people to invest in it as a first move. They always look at, are you confident in your own economy first before they can come in? So we have to be confident about what we see in the continent in terms of the opportunities, but just the long-term potential of the continent. And we put, our money in the continent. Then others are going to come as an addition. But we have to invest in the continent first before we expect external.
Isaah, now African leaders have been really complaining about global markets, how unfair they are in pricing African risk. And there's been growing calls for really Africa to use African credit rating agencies and have an established rating agency for Africa. Is this the answer? I mean, what do you think is the way forward? Because, of course, African leaders really feel they have a legitimate complaint.
Look, the complaint is legitimate. If you look at default rates for project finance in Africa relative to other continents, they're much lower in Africa than other continents. But if you look at the cost of financing projects in Africa, is higher. You typically think about default rates as a big indicator or driver of how much you have to pay. If you have a lower default rate, it means your interest rate also should be lower. But that's not the case. So it's a valid concern. But as to how it's addressed, it takes different facets. So there is one, potentially the one that you allude to, having an African credit rating agency that could address to an extent, but it's not the totality of the solution. The other one is, if you think about how credit rating agencies get to assign a credit rating, take all the information that you have, they assess your ability to repay debt. It's your institutions, it's your macroeconomy, it's your response to crisis. That gives them a sense of your ability to repay debt when it's due. Now, part of the reason is lack of data. If you don't have data, it's difficult to assess your ability to actually repay because you simply don't have data. And most African countries, it's excruciatingly difficult to get data. So when you don't have data, what you then do is you just put a risk premium that is large enough to be able to cover for this unknown world that you don't know because you just don't have access to information. So part of the response is making sure that we measure economic performance better, we make data available, easier for investors and credit rating agencies to be able to assess the true performance of the economy. And that is an us respond, making sure that we measure economic activity and we make the data available publicly. And in the measurement, we also have to be quite transparent in how we do it, because sometimes they are economic statistics that get manufactured, which doesn't give true reflection. And in some cases, some countries, they hide debt, which they have, which also doesn't do good for countries. So it's a variety of things. And then there's also an investor response to it to be fair in the assessment of the credit ratings. Given data, when default rates are low, you have to then say the risk premium should be low. That's an investor and credit rating agency response. So it's a multitude of responses that requires us from an institutional framework and data availability, but also from the investors to actually look through and be fair in the assessment of the risk, the true riskiness of projects in Africa.
So Isaah, just before I let you go, last question. I mean, given everything that you've outlined, explaining what's exactly happening to countries, given the global uncertainty, in your opinion, what sectors offer us some of the big investment opportunities for the year ahead?
Africa is potentially the next growth frontier. If you look in terms of the fastest growing economies in the world, in the top 20, you find more than half of those countries are in Africa, that are growing faster than the rest of the world. If you look in terms of the demographics, Africa has the best demographics compared to any other continent. The median age in Africa is 19. The next lowest age is 40, that's Europe. Asia is aging, North America is also aging, which means the demographic dividend still lies with Africa. And by 2050, you have 2.5 billion people, almost 1 out of every 5 people on Earth will be African. That's a massive market that will be created for the world. But then if you look in terms of the need for infrastructure, we need roads, we need rail, we need ports. Those are investment opportunities that investors can look at. But again, by 2050, we have 8.5 billion people on Earth. They need to be fed. Who is going to produce the food? Africa has 30% of arable land, which means agriculture is one of the potential sectors that can give return on investment, because you have to feed the rest of the world. You can't do without it. So whoever is in a position to supply food to the rest of the world is going to do well. And you also would need a healthcare sector. With 2.5 billion people, they would need access to healthcare. So which means it's a sector that can do well. Critical minerals. This whole decarbonization and greening the global economy or Earth means you need critical minerals that are used in green energy. And most African countries, or many African countries, they have mineral resources that contributes into greening the global economy. So that's another investment opportunity that investors can look at. It's education. It is a sector that can make sure that Africa actually harnesses the demographic dividend. Until you skill people, that skill can easily be another risk you have to deal with. Because when people are unemployed, because they are unemployable, because they don't have skills, then you have potential for civil unrest across different countries that can be a risk. So there's need to invest in skills to make sure that we actually get a dividend and not a risk of protest from the youthful population that we have. So it's several economic opportunities for investors that lie on the African continent.
And there you have it. Thank you, RMB's Isaah Mhlanga, outlining to us what lies ahead for Africa.